Residential Sales Comparison and Income Approaches, page 162. Reserves for replacement. There are certain components or items of any structure that will need to be replaced from time to time throughout the life of the building. For an income-producing property, the anticipated cost of replacing these components or items is addressed by reserves for replacement. Reserves for replacement, sometimes called just reserves, refers to an amount of money set aside for future replacement of major items. When used in an income analysis, the replacement reserve is most often applied as an annual dollar or sometimes as a percentage amount. Although there could certainly be others, common components or items for residential income properties for which a replacement reserve is typically include roof, heating and/or air conditioning systems, carpeting, and lesser furnished appliances. Rent and income factors. Multipliers are rent and income factors, frequently used in the valuation of many residential income properties. The use of rent and income factors as a technique in the income approach is an income capitalization method, as we will discuss in Chapter 6. In order for a meaningful and credible value opinion to result from applying multipliers, the data from which the multiplier is extracted must be very similar to the subject in many ways. Physical features, lease terms, and income expense history. A multiplier is not a percentage. A multiplier is identified as a factor derived by dividing the sale price or sometimes value of a comparable property by its gross income, or in some cases, rent. Multipliers are derived using this formula. You take your sale price, or which it could also be value, divide that by your gross income, or rent, equals multiplier. That's the formula right there. Pretty much price divided by rent equals multiplier. That's how you derive that multiplier. That's very important. There are two types of multipliers that can be applied. The type the appraiser will choose depends on the property characteristics and is decided in the scope of work of the assignment. These factors are known as gross rent multipliers and gross income multipliers. Gross rent multipliers. A gross rent multiplier, or GRM, is a factor derived from comparable rental data, which is then used to develop an opinion of value of the subject property. A GRM is used when the property has income that is derived only from actual rent of the living units. Although the multiplier could be expressed as either a monthly or annual factor, it is most commonly derived on a monthly basis. As we will see in Chapter 7, most residential appraisal firms report the development of the income approach by this technique in such a manner. Operating expenses encompass all of the expenses that are necessary to adequately maintain a property and its income potential. Page 163. Some information sources discuss a gross monthly rent multiplier, or GMRM. While this may not be a widely used or applied term, when used, the term emphasizes that the factor is expressed as monthly. However, the term GRM is most prevalent and is applied most frequently on a monthly basis. The key is consistency. If extracted from comparable data as a monthly factor, the multiplier must be applied to monthly rent data as well. Gross income multipliers. A gross income multiplier, or GIM, is a factor that takes into account income derived from all sources of a property. It is most often used when there are income-producing capabilities of a property other than the rent derived from living units. For example, a small residential income property with 4 units might have garage or parking spaces that rent to parties other than the occupants of the living units. Or there might be a coin-operated laundry facility on the premises that derives income. It is most common for GIMs to be derived from and applied to annual income. However, the process of derivation and application of the factor is much the same as the GRM. The basis of income derived from and applied to the development of the GIM technique could be based on either potential gross income, PGI, or effective gross income, EGI. In such cases, the multiplier resulting would be either a potential gross income multiplier, or PGIM, or an effective gross income multiplier, or EGIM. Application example of PGIM versus EGIM. If a comparable income property was significantly similar to the subject with the exception of its occupancy level, extracting an EGIM factor from the data would prove to be more meaningful than using the comparable property's PGIM. Of course, in such a case, the EGIM that was identified from the comparable property would be applied to the subject's EGI, effective gross income, rather than PGI, potential gross income. We will look at this application more closely in Chapter 6. Rates of return. There are various rates of return that can be used in different techniques for development of a value opinion using an income capitalization method. 2 types of rates that will be discussed here are the overall capitalization rate, an income rate, and yield rate. Reflects the anticipation of all future benefit returns. Rent and income factors, as well as rates of return, can be extracted from market data and applied to the subject's rent or income to produce an indication of value.